So this paper, which Dave Rapson, my co-author, is going to take you through the results. I'm going to just try and introduce it for a few minutes. We have a total of 30 minutes, so I'll just try and spend like 8 minutes just talking about the general idea. Is trying to compare the fair tax total effective marginal tax rates on marginal work with and also on saving with those arising under the existing system. And by the fair tax, I mean what's in H.R. 25, the actual proposed law. So I'm talking here about a 23% effective rate on labor supply, and it's also an effective tax on wealth, as we talked about earlier. And the effective tax rate under the fair tax on saving is 0, because there's no distortion on this decision about consuming today versus consuming tomorrow. So what about the existing system? Well, the existing system is a pretty complicated animal, and when Bill Gale wrote his rather strongly worded kind of analysis of the fair tax, where he ended up with a really high tax rate, he didn't bother to try and compare the fair tax tax rate, whatever he thought it was, with the actual tax rates under the existing system. The existing system has lots of different tax features, as we all know. You know, got the and I'm not even going to talk for the moment about the benefit system or state income taxes or excise taxes, all of which affect both the taxes on the margin of working and also on saving. So this paper is just focusing on the income tax, both the corporate and personal income taxes, and comparing those under the fair tax with the existing system. Well, the existing system, as you know, figuring that out is no picnic. What do we got going on here? Well, we've got the in addition to the regular tax brackets, we've got the earned income tax credit, the child tax credit, the alternative minimum tax. We've got Social Security benefit taxation, the decision whether or not to itemize deductions, the indexation of tax brackets, exemptions, and the standard deduction, the non-indexation of the thresholds for Social Security benefit taxation, the two different thresholds there, the interaction of the federal income tax with each state's personal income tax. I'm leaving out state taxes in this analysis, actually. And then you also have to think about, we do include in this analysis the fact that if you work more, you earn more money, you'll affect your Social Security benefits. Well, there's 2,528 rules determining the calculation of your Social Security benefits, both your regular retirement benefits and your survivor benefits and your child and mother and father benefits and your divorcee benefits. I mean, it just goes on and on. There's all kinds of special provisions once you've calculated the PIA, you know, this early retirement benefit reductions, delayed retirement credits, recomputation of benefits, the earnings test, family benefit maximums, the scheduled rise in the normal retirement age. And then you've got the payroll tax, which we do include in this analysis too, to think about, because the payroll tax is being paid partly by employers and partly by employees, and the employer portion is not subject to federal income taxation. And then there's the projected increase in the ceiling. And then we also have to think about what the U.S. corporate income tax is doing to after-tax returns, or whether that's really a tax on labor supply in an open economy. That's really, a tax in effect on the wages. In this discussion, we're treating the U.S. economy as a closed economy, but that's up for discussion. So this is a terribly complicated thing. You've got to think about if you're trying to understand your incentive to work and save, you not only have to think about all the years in which you might be alive, you and your spouse, if you're married, but also all the years in which you're dead and your spouse is alive, and all the years in which she's dead, if she is a she, and you're alive. And there's lots of survivor states, because you could be dead, you could die 5 years from now, and then you got to think about what your, let's say, widow is going to be paying in taxes at the margin, and also on average 20 years from now, because you're thinking about saving an extra dollar. What's it going to mean in terms of her taxes when, 20 years hence, if you die 5 years hence? that's different than if you die 6 years hence, because how much you leave her and how much you will have earned and how much your Social Security widow benefits will be different if you die 6 years hence from 5 years hence. So all this has to be calculated in your if you've got a brain like mine, it's rather small. I don't have any Pentium 4 chips implanted in my brain. It is literally impossible to do these calculations in your head. I had a chance about a week ago at the University of Michigan to ask a set of 15 economists who are experts in retirement and saving issues I gave them a very simple middle-class household situation, some earnings, some retirement accounts, some kids they're going to pay college for, and I asked them, no uncertainty, and I told them, and I asked them to tell me how much this household should save and how much it could consume on a sustainable basis. I made it really simple. Actually, I didn't even have kids, and they were wildly off. I mean, just dramatically off on both the downside and the upside. 15 people doing this calculation in their head. So they would also be wildly off on what marginal taxes are that they face. The software that we use to study that, and this is all by way of saying that we need to get rid of this crazy system that we've got and go to something very simple and transparent that everybody can understand. Otherwise, we're generating who knows what kinds of efficiency deadweight losses when people might think they're in much higher tax brackets than they actually are or much lower than they actually are. So what do we do to actually analyze what's going on in the tax system since we can't figure it out right here? Well, I and Jagdish Gokhale developed something called ES Planner, Economic Security Planner. It's a software program which we market. I'm not trying to do a sales pitch here. Anybody can get it for free who's an academic who wants to use it for academic purposes, or even just ask me, I'll give it to you. So the software is calculating within about 8 seconds all these taxes and all the Social Security benefits in great detail. It's got 2 dynamic programs. It's doing its calculation subject to borrowing constraints, which also makes it pretty complicated. It's doing all these calculations using 2 dynamic programs, one to do consumption smoothing, one to figure out the life insurance needs at every date in order to protect the living standard that the first program is generating. And the 2 programs are iterating because there's a simultaneity when you have progressive taxes. You can't know your future taxes until you know your current spending, and you can't know your current spending until you know your future taxes. So to figure out where you are at the margin 20 years from now, you need to know what you're doing now. But you can't, it has to be done iteratively to solve this very complicated simultaneity problem. We've spent about 13 years developing this software. We think we've got it right. It's got all kinds of very fine details about the tax system in there, the alternative minimum taxes code, or the earned income tax credit, the child tax credit. All these Social Security benefit provisions are incorporated. And so what we do is for this study, we ask the question in the program, what if somebody earns an extra $1,000 this year or $500 this year, and they spend it all this year? How much more could they spend? So how do we get that to happen in the program? Well, the program is basically saying you tell the program what the resources are, and it'll come up with a smooth path subject to borrowing constraints. But there's another feature in the program that we use, which is a living standard index. So you can tell the program that you'd like to spend more. You'd like to have a higher living standard now and a lower one in the future, or a lower one now and a higher one in the future. So we can give somebody an extra $1,000 this year and play with this living standard index, so that standard living index, so that they actually spend it all this year. So we can ask the typical marginal tax rate question for labor supply, which is if you earn an extra $1 this year, how much could your consumption go up this year if you spend it all this year? And then with respect to the issue of saving, what we do is we say, well, what if somebody somebody doesn't earn anymore, but they just decide to consume less? Let's use our standard living index in the program to get the program to reduce spending this year on consumption by $1,000 and have it spent and use those resources that are freed up to generate a uniform increase in the living standard from next year onward. And then the question there is, how much in present value does your future consumption go up if you give up $1,000 in present value right now in current consumption? And if your future consumption goes up by $1,000, then you know there's no effective tax measured in present value. But if it goes up by only $500, then you know there's a 50% effective tax on saving. The reason we're trying to spread it out, talking about a uniform increase, is that the answer to how big the effective tax rate is depends on how far out you go, as Christoph Schomli first pointed out back in his thesis back in 1977 when we were in graduate school together. He didn't actually publish this paper until '86, but I think he was the first one to put his finger on the point that if you have a constant capital income tax, the effective tax on consumption far out into the future goes out off to infinity because the rate just kind of compounds. So let me stop there, turn it over to David to actually take you through the results.
Well, I'm going to try to get us ahead of schedule here. I don't think it should be a problem. Larry has gone over a lot of what I want to say, I think, and really here to just try to run through the methodology a little bit of the estimates that we have of the current tax system, and then show you the results. Like Larry said, the program that I was using throughout this, ES Planner, has been developed since long before I entered onto the scene. And so mostly what Larry needed was a quant jock of sorts, and so I tried to put on my cap and crunch a lot of numbers, and that's pretty much what it came down to. But it was a very interesting exercise because there are a lot of complexities, and I think I had to understand the tax system a lot more as I went through the process than I did at the beginning, where I just had no idea what was going on. Okay, so the working block of this program or of our analysis is these stylized households that we developed to basically represent a whole range of different households in the real world. So we gave them some assets to start out with. We started them at different ages. We had households starting at 30 years old, 45 years old, and 60 years old who have kids at age 27 and 29, and they go to college when they're 19. These households buy houses, they have a mortgage, and they have other non-fungible expenses that we impose upon them. We also give them annual income, and based on all of these and interacting this with the tax system, which is what ES Planner does so well, we're able to come up with the optimal consumption path. And so I would enter in these base case scenarios. The ones that I just showed you were just the standard, what would the household do in the current tax system, and then by altering things, giving them more income, forcing them into savings, we can compare then how they alter the life cycle consumption path based on the output that ES Planner gives. And as we need to, we can change the borrowing constraints or change the standard of living as required. So the typical output of ES Planner is just an Excel spreadsheet with expenditures on consumption or other things that we specify, as well as taxes. And I would just throw these all together, and I'll come up with something that I've similar to what I've cut and pasted here. And as you can see, if we just look at these two left-hand columns, the base case income and the adjusted income, all these figures are in present value. What I would do is give, in the adjusted income case, give the household an extra $1,000, and that's going to result in a shift, as we know, of the consumption path throughout their lifetime. I would then use the standard of living adjustment feature to make sure that in all years from 2006 until the end of their life, I would adjust their spending back to what it originally was before I gave the additional income. So in that way, we can then compare, assuming that the entirety of the $1,000 that I gave them was spent today, we can use that to come up with the tax rate. And so For this household that we have here, it's a 30-year-old couple that earns $30,000 in a year, and we can see that we came up with an effective marginal tax rate of 33.7%. Another thing to note is that obviously in this calculation what's important is also the FICA tax, the employer FICA tax, which is not explicitly included in the ES Planner program because we don't really think of our income in that way. So the adjustment that you see in the equation at the bottom with the 77 extra dollars represents the employer's contribution to the income. So we're giving them $1,000, but in the absence of FICA, they would have also received that $77. So that needs to be included in the denominator. Okay, the second type of tax rate that we estimated was the marginal effective tax rate on savings. And here, this is actually a little bit of a simpler calculation. All I did here was adjust the standard of living from 2006 through the end of the life, so that it would induce the household to defer consumption away from today and throughout the remaining periods. For this exercise, we relaxed the liquidity constraints. Most of these households, except for the very wealthy ones, run into liquidity constraints at some point in their lives. Generally, the way that our stylized households were set up, that occurs when their kids go to college. So in this, to avoid that problem, we relaxed the liquidity constraints in this case, and so that wouldn't be an issue. So as you can see, raising all future period standards of living relative to today will cause you to consume less today and consume more in the future, and taking the present value of those future adjustments relative to the change in consumption today is going to give you a measure of the tax rate, the marginal effective tax on savings. And the final tax rate that we measured in this paper was the average remaining lifetime tax of these households. And we wanted to do that. Well, I mean, obviously all of this in the end was to compare it to the fair tax as well, but it was important just to get an idea of this for the regular tax system to begin with. Now, some of the fair tax details include an elimination of the corporate tax, so we needed to somehow get at that. The corporate tax obviously isn't explicitly in ES Planner either. So we got at this through the expected rate of return that the household receives on its savings. So in the absence of corporate taxes, we assume that they'd get a pre-tax return of 7%, and then assuming a 35% tax, which actually Jane Gravel gave us as a figure, we use 4.55% as the return they received on their savings with the tax case, and then we compared the two scenarios. One scenario with the current tax system and the consumption that occurred there, and then we eliminated all taxes entirely, and we saw what the path of consumption would have been in the absence of the tax system, and we concluded that the difference there could provide us a measure of the average remaining lifetime taxes. Okay, so on to the results that we found. These are straight out of the back of the paper there. What we have here in these two tables, the top one compares the marginal effective tax on working under the current system versus the fair tax for single households and married households. And just about across the board, the fair tax is, well, obviously the fair tax is at a constant 23%, and even, there's obviously some controversy about that number, what that number would actually be. But even if it's a bit higher, we can see that under the current system, the marginal taxes are very high, almost across the board. I've circled a few cases that are interesting. The bottom case there under the married households is the one that I calculated earlier. But if we look above at 30-year-old single households making $35,000, their marginal tax rate is up above 50%. which is extraordinarily high. Some of the lowest income single households are facing a negative marginal tax, and that's due to the earned income tax credit. But the average taxes, as we'll see later, under the fair tax would also be negative because of the rebates. So the marginal taxes here, are obviously less under the current system, but the 23% marginal fair tax should also be interpreted in the context of this refund that's being given back to the lump sum. Oh, and the one final bullet point that I have here is just obviously the current system is very complex, and you can see that in the lack of monotonicity here in the marginal tax rates. As they just go up and down. It's really hard to predict ex ante what the marginal tax rates are going to be for any given household characteristics, and that obviously is a benefit of the fair tax, which is much simpler. The marginal effective tax on savings also has some really stark comparisons to be made. Under the fair tax, it's obviously 0, and the lowest marginal effective tax on savings under the current system doesn't go below 20%. So that the disincentive that the current system offers for savings will be eliminated by moving to the fair tax. And the rate, as you can see, for the wealthy married couple or wealthy married households can be up over 50% on the margin for savings. And this is exactly the same slide as the last one, except treating all savings as dividends and capital gains. The rates are a little bit lower here, obviously, especially for households that have a lot of asset income. So instead of having 50% marginal tax rates on savings, the wealthiest married households are now down to 40%. And the final slide of results that I wanted to show you is the average remaining lifetime tax on work. Because of the broadening of the tax base, the average lifetime taxes under fair tax are lower than under the current system, and often by a substantial margin. Some interesting figures are for the seniors, or the 60-year-olds. They have only a very few years left in their working lives. They face a negative remaining lifetime tax. There are 3 reasons for that under the fair tax proposal. One is that fair tax preserves the real Social Security benefits of the elderly. The second reason is obviously the rebate, and then the elimination of the FICA tax also eliminates a regressive component of the current tax system. And then I've just circled in the center column there a couple of examples of typical households that would have a much lower average remaining lifetime work tax under the fair tax than under the current system. And that's it.
Yeah, that's it. Thanks.
You did good. Well, okay, so our first discussant for this paper is Dr. Jane Gravel of the Congressional Research Service.
Thank you. I always enjoy commenting on Larry's papers. Since we, as you may know, have been co-authors in the past, so it's always fun to criticize a former co-author. Actually, I'm very impressed with this program for calculating marginal tax rates, and I would like Larry to send me a free copy. But it's some of the things that a lot of people who are trying to do all sorts of analysis struggle with, is how to deal with situations where there are future consequences to a tax right now that you need to take into account. And you would like to get the life cycle right, but this is certainly the way to do it. I'm really, really very impressed, and I hope this tool will be become more widely used. And I'm glad I had a little opportunity to contribute to it. But having said the nice things, so I want to talk about two issues. And those issues, first, is a conclusion that the rates on labor income are lower under the fair tax. Is that conclusion correct? And I'm not convinced of that. And the second is, since I really don't have very much to say about their methodology, I mean, I'm going to stop talking about their paper and just talk about the fair tax in general. And so the second question is, are these marginal tax rates the most important consideration actually considering moving to the fair tax or to a similar sort of consumption tax base? So now, it's one of the problems with their presentation is that there's no sort of weighted marginal tax rate. I mean, you don't know what, putting all these numbers together, it looks like they're higher, but you'd really have to put them together. I didn't do these numbers in the diagram on the weighted marginal tax rates on labor income. They actually come from a CBO study that's been recently done. It looks at these are the average marginal tax rates on labor income as calculated in their study under the 2005 tax law, and also under the situation where you repeal the temporary tax cuts enacted in 2001. As you can see, the current law is actually kind of a fairly low point, particularly with respect to the income tax, because of which is, you can see by looking at the deficit and how much the income tax is as a percent of output. Now, if we go to the fair tax, under these assumptions, which is a fairly low tax right now, replacing the revenue under H.R. 25, these are some calculations a colleague of mine, Max Shvedov, did at CRS for H.R. 25, and he actually finds the fair tax kind of hits at 23%. But then the problem is, how are you going to compare this tax with the current income tax? And the current income tax has some evasion. So you could either say, if you're looking at the marginal tax rate on labor income, you could either say it's some average of the statutory rate and a zero tax rate for the people who are not paying at all, or you could gross up the fair tax by the amount of the evasion. I mean, but you can't compare the fair tax with none of this to the current system that has all of this. And the same thing with preferences. If a piece of my income is going to be exempt because I'm going to spend it on charitable contributions or fringe benefits or something that's not taxed, then that effectively lowers my marginal tax rate on labor income. So what I want to do is try to do really sort of a fair comparison. So the second number also my colleague provided, this is actually adjusting. And I guess the third thing I would say is that if we can cut non-Social Security spending by 20% under the fair tax, we could also cut it under the existing tax. So if you're going to be fair in comparing this, you've got to make all the same assumptions. So the second number adjusts the fair tax rate up to account for the fact that government purchases will have to go up in dollar value in order to keep the same real value of government spending. And this is actually very much the kind of methodology that Bill Gale has used. Now, the third number, then, is to adjust for evasion in the current tax. Now, this is not an argument for saying that the fair tax will have more evasion or less evasion. It's just saying, to make them comparable, let's do approximately the same amount of evasion. So I divided this number by 0.15. That's the evasion in the current income tax. I'm not sure if we have a good handle on how much evasion is going on in payroll taxes. Not much for wage earners, but a whole lot for the self-employed. Now, the last one I couldn't do, because I didn't have time, actually, to try to work on this, because Larry very kindly stepped in late in the game to present this paper, and I stepped in late in the game to review it. But it would be bigger. Okay, so now if I look at these numbers, I would say, okay, the tax falls somewhere between the income and income plus payroll tax. This is some benefits, connected with the payroll tax that you're going to get in the future. Your tax planner could probably tell me how much they are, but right now I don't know, but I know it's somewhere in between. So it looks to me like even under the fairly low tax rates now, The CBO estimates don't look to be much different and probably actually a little lower than the estimates under the fair tax. So I'm really not sure that the argument that the marginal tax rates are lower under the fair tax really kind of stands up to this type of analysis. And in some ways it should not be surprising, because a consumption tax base is in general a little smaller than the income tax base. Right now it's just a tiny bit smaller because the savings rate is so low. But anyway, this is how these numbers come out. Okay, so now I want to just talk now for a minute about the issues surrounding the fair tax. And when I say the fair tax, I'm also really talking about the value-added tax, which I think is a very similar sort of consumption tax move, and also the flat tax. First of all, there's no tax on capital income, and that certainly has some benefits. In fact, one of the more important benefits that it has that people don't talk about very much is it eliminates all these intersectoral distortions. It eliminates the distortion between owner-occupied housing and the corporate sector, the non-corporate sector, debt and equity, dividends, payouts, all those different kinds of distortions. And I think that's probably fairly important. In fact, Leary and I think that's fairly important from some work we've done in the past. So that's an important issue. But it's probably not going to do very much to change the revenue base, because most of this is not only a piece of these excess burdens is in, an actual increase in output. Most of them are in sort of utilities. And it also eliminated the intertemporal distortions. I don't think those are as big as some people do, but it is another distortion. The work disincentive, as I said, I'm not sure what the work disincentive distortion is. I'm not sure it's actually better under the fair tax. And then I just think one sort of caveat to looking at these marginal tax rates on labor income is that when you start to look at things like the EIC, which probably mostly affects participation, you need to look at the participation margin and not necessarily the hours margin. And I believe the evidence is that the EIC has probably increased work effort on average, even though there are some high negative marginal tax rates in the phase-out area. And the third is how large are these responses? In the interest of time, I won't lecture you on how I don't think they're very large. I'll invite you to read my presidential address to the NTA, or to read a paper that I wrote with Kent Smetters and Eric Ingen, or many, many things I've written, or a paper I wrote for this conference about 10 years ago. But I think there's a real question as to how large these responses are. These life cycle models have not been empirically tested in the direct fashion that some other things have been. I mean, they have some empirically generated relationships in them, but nobody has tested the substitution between consumption between now and 55 years from now. Nobody's done any empirical work like that. Also, actually, I'm probably one of these people who don't help, quote, radical tax reform to come to fruition, because I do talk to the policymakers. And one of the things that I tell them is the big short-run responses in this model are due to two things: retired people rising from their sick beds and returning to work because of the lump sum tax on old capital, and workers responding to the rate of return and shifting their labor income to the present so that they can save and then have leisure in the future. So, other issues. Well, there's the issue of evasion. Some people think evasion is a big problem. I don't really know, but some people do think it's a big problem. Anytime you have a flat tax, you almost inevitably have to do some vertical distribution from high-income people to middle-income people. You can protect a low income with demogrants or whatever, but you sort of can't avoid this shift. The lump sum tax on initial capital owners may be great for efficiency, but you do have to ask how fair you think it is. But the most important issue, to me, is the macroeconomic transition. Nobody talks about that. Sometimes when they talk about it, I think they dismiss it too quickly, but I think until we confront this particular issue and decide that it's feasible to do this macroeconomic transition, I think that this kind of radical reform is just not going to be seriously considered. So what is it? Well, using the numbers I just calculated, In order to go immediately to the fair tax, national retail sales tax, we either have to have a price rise of 47%, or we have to have a fall in wages of 32%, or we have to have some combination of that. Is this possible? Well, if you think so, I'm going to give you my views as filtered through the words of George Strait, a well-known country and western singer. You probably don't know country and western. You probably know opera here, but I'm originally a country girl, so I still like it. And here's what he said in his song. I've got some oceanfront property in Arizona, and if you'll buy that, I'll throw the Golden Gate in free. Courtesy of George Strait.
Yeah, they do it. I was remiss in not thanking David and Larry for filling in at a very late date. Jane for filling in at even a later date. She's going to discuss the next section as well. And then George Yin and Peter Miskowski for being very flexible and allowing me to move them around on the program. So thanks to all 5 of you. The next discussant is Professor Peter Miskowski, Rice University. He's the Klein Professor of Economics.
I didn't know what I was going to say until I saw Jane's comments, because I didn't want to at least repeat what has been said today. So I will not try to summarize the results of the Cutler-Rapson papers, since they've been set out, and I won't. I guess I should mention my the skepticism that the rate can be as low as 23%. Now, I'd like to perhaps be a bit broader than just the paper. I want to also make reference to the paper that Larry did with Sabin Joskic on the sort of macroeconomic effects of the fair tax. Because the reason I turned to that paper was that when I saw these average tax rates calculated, all the average tax rates were lower, so that somehow there had to be something behind those. So of course it's the hit on old capital that is clearly set out in the simulation model of the other paper. But I have basically three general points. One relates to whether, in fact, the marginal tax rate on savings, in fact, is zero under the consumption tax, or perhaps another way of putting the point is, and this is not a new point, I think it's important, is what's the relevant rate of return that we should be looking at when we try to get at the distortion of the related to the savings decision that is characterized as deferring consumption. Gentry and Hubbard, in well-known paper, and then Hubbard in other papers, has tried to minimize the difference between income taxes and consumption taxes for distributive purposes, and they point out that part of the rate of return can be either return to risk-taking, and another component can be rents or the returns to new ideas and so forth. And their general point is that to the extent that risk-taking is concentrated in upper income groups, or to the extent that high income groups are more likely to be entrepreneurial, then we need to take that into account. We need to take that into account in distributional analysis. And of course, if you do that, then the consumption tax it will look more progressive than if you do not. Now, somewhat different strand of literature, perhaps more fundamental, begins with the work of Roger Gordon in the 1985 paper, which I think now has found imitators. And his general point is that once you account for risk taking, then perhaps the corporate income tax and the personal income taxes aren't as distortionary as sort of conventional analysis will have it. And his basic point is quite simple: is that the after-tax rate of return will fall, but also the government, under perfect loss offset, at least will share in the risk. So the allocative effects and the allocative effects of even a tax that generates a substantial amount of tax revenue may be quite small. Or putting it somewhat differently, if you're going to talk about the distortionary effects of income taxes on savings or investment, you should really be looking at the normal rate of return, or at least that's the. So what does this all add up to? Well, it adds up to the fact that in simulation work, when you take the whole rate of return as the sort of normal rate of return implicitly, you may be significantly overestimating the behavioral adjustments that will ensue after the switch from the income tax to the consumption tax. Now, as I say, this is not a new point, and I think there's at least one other paper on this program that will address this issue, but I think it's important, and it certainly bears on the Kotlikov-Joshkin's paper, and also bears on the interpretation of the conclusion that the marginal tax on savings in these calculations is nil. But the second point I want to talk about relates to distribution, and I was going to compare the results of my own work with Michael Palumbo, which is done with conventional static analysis, but is done using income tax records, which allows one to look at a very wide range of different types of taxpayers, all the way up to $1 million, people with $1 million a year. Plus, the limitations of that analysis is, of course, it does not allow for behavioral adjustments and growth effects and so on, which are, of course, fundamental to the issues under discussion. But let me say quite quickly, the results of the static analysis, which included the fair tax, in that we had the demogrant, or the tax. We did calculations with the tax rebate. I think they're quite consistent with Larry's results, and I certainly agree that that you can have, that if the fair tax were to be introduced, that it would certainly be a progressive tax at the lower end. Now, I want to raise one question here, or make one qualification to that agreement, and what we found when we did the the calculations was that the combination of the indexing of Social Security and then also the rebate lowered the tax liability all the way up to about $25,000. So the fair tax is better than the existing system at the lower end of the income distribution. On the other hand, the tax burden is pushed upwards onto the middle class, with the largest increases occurring in the $50,000 to $100,000 range, and in the high income group, $200,000 to $500,000 gain relatively little. On the other hand, when you go to the very top, at least our calculations for the fair tax with the demogrant indicates that group's tax liability is cut by nearly a half, probably about 45%. So the reason I raised that point is that in the Joshki's paper, there are only 3 income groups. I can't find them very well defined, except there are low income, middle income, high income, and then I mean there are transitional effects, and I will skip over the transitional effects. But the important point is that measured in terms of the changes in welfare as measured in percentage terms, the lowest income group gains throughout the birth cohorts. In other words, they have birth cohorts, people born in 1920 and then people born in 2030, and there's a significant improvement in the utility of the low income groups. In fact, the people born in 2030 who are a low income group gain about 24%, and the basic reason for that is that they pay no payroll tax, and also because of the increase in capital formation as a result of the introduction of the fair tax, their wage rates are significantly higher. The middle group, at least in the long run, birth cohort 2030, gain about 10%, and the highest income group gains only about 4% in the long run. So what I would like to do is to simply suggest that there may be the high level of aggregation may be simply masking the fact that the high end of the income distribution, the really high end of the income distribution, will be in fact better off under that. But I mean, that's only speculation, but it's suggested by the types of results that we got with this static analysis, because it appears, except at the very top, that the affluent are paying either higher taxes or more or less the same taxes. But when you disaggregate at the very top, there is that decrease that I mentioned earlier. Now, finally, my final point, here I'm blowing my own horn to some extent, and perhaps this is addressed more to Leo Lindbeck than to you, Larry, but when I worked on the fair tax, worried a lot about compliance, and I guess I'm very skeptical that you can have high rates of compliance without having a central administration. So I'm skeptical about the prospects of the elimination of IRS, and more generally, written a paper suggesting that perhaps one way of improving, that Leo has seen, I believe, suggesting that one way to go would be to move towards a hybrid system where you would introduce withholding at manufacturing level and wholesale level for, at least for consumer goods. And I mean, I won't go into further detail, but I think that's the compliance issue. I mean, there's been a lot of discussion today and more generally about what the relevant tax rate is, but I think the fair tax is in trouble politically because many people don't think that sales taxes over the rate of 10% or whatnot are administrable. Thank you.
Okay, we'll have a short time for questions and rebuttal. So we'll let Larry have 3 minutes. Good. 5.
Yeah,
5 minutes questions.
these are brilliant comments by in both the American and the British sense of that word. Let me just respond that not that I agree with any of them, but no, actually, no. Some I do agree with. Fair tax rate would be higher. This is Jane's proposition. Well, yeah, I didn't. When I talked at lunch, I said that this didn't include evasion, how much the other spending would have to be cut back, but nor does it include the growth effects, which Peter was alluding to, that are suggested by this very stylized study that's with Sabine Jokish and Hans Fair. That's an NBR working paper. It's also on my website about the simulation impact of simulating the transition to a fair tax. I think they're roughly kind of, at least first order, kind of offsetting, that you wouldn't necessarily, a 23% rate would have some evasion, but then you'd also have these very substantially, potentially very large growth effects. And yeah, they would take a while to materialize. And they're not coming, Jane, from, really high compensated or substitution effects. They're really coming from income effects. And the fact is that when you take, so the life cycle model, these simulation effects from the life cycle model aren't, we have pretty parsimonious or pretty small elasticities, I think. Maybe you think they're too big, but I think they're pretty small. But you really have to understand that that absent the income effects, you'd get no growth. If you go to a wage tax from an income tax in our simulation model, you get a smaller capital stock in the future. Everything's being driven by the income effects. Now, if you take resources from young people and give them to old people, that's the income effects that we're talking about here. In the U.S. economy, you'll get a lot more consumption. We see that in the fact that the consumption of the public sector, the private sector, relative to national income has gone up dramatically. That's why our national saving rate is so low. And then if you look at the consumer expenditure data, you see the age consumption profile shifting dramatically toward the elderly. So that it's really the elderly whose consumption's gone up. And then if you test altruism, which would be the only argument against income effects, that you give the money to give the resources to the elderly from the young, and the elderly hand it back, well, you get very strong rejection of that proposition in micro tests. So I think there's actually very strong evidence for the life cycle model. It's maybe not of the kind that, at least it's of the kind that you were thinking about or looking for, but I think there is actually very strong validation of the life cycle model in empirical studies. The excess burden is also kind of second order. I'm not claiming that we're going to have big growth effects because of elimination of excess burden. I think there'll be some improvement. Maybe it's utility. Maybe it'll show up in some output. But I'm also with you that that's going to be second order. I'm just saying, to the extent that people are concerned about excess burdens, this tax system would have a much lower efficiency costs than the current system. Now, Peter pointed out that to think about the efficiency effects of capital income taxation, you also have to think about the risk-sharing effects of capital income taxes, and that this analysis probably should be based on what he referred to as the normal rate of return. I guess he really meant the risk-free rate of return, which is currently about 2.5% on tips, long-term tips. And we use like 4.55 in our as the after corporate return. So, yeah, we could redo the analysis with a lower number there, and that would show a smaller effective tax rate on saving under the existing system. So I certainly agree with you, Peter, that maybe we're a little bit high on that side. On the other hand, we're using a pretty low inflation rate given what's likely to arise in the future. With a higher inflation rate, you'd have a higher effective tax rate on capital, given the fact that the capital income taxation is not indexed for taxing real capital income in the U.S. It's taxing nominal capital income, so the effective rate goes up with the inflation rate. Now, what else do I want to say? Well, the last thing I want to say is about compliance. Yeah, I agree, Peter, that is the major, probably, stumbling block to the acceptance down in Washington of, or at least the concern that I've heard the most when I raised the issue of the fair tax, the issue of compliance. And I'm very eager to hear what your ideas about how to better enforce it. But I do want to point out that everybody who's now working for the IRS would be freed up to enforce this single tax. We wouldn't have all these different tax systems that the IRS would have to deal with. So you have all that workforce, and we also have all the accountants and the tax lawyers, the estate lawyers. These are very smart people. We could take all those resources, and that comes to probably $300 billion of GDP, and that would be freed up, and we could devote that to enforcing the fair tax. I think we'd be able to figure out how to do it. We might have undercover IRS agents asking to have their lawn cut, and see if the guy who's cutting the lawn boy who's cutting the grass actually sends in the tax payment. The last thing is the macro effects that Jane referred to, and I think she's thinking about price increases and whether the country could live with a 30% price hike if that's what it came to, if the Fed accommodated this, which is what I think would happen. Well, I think this country has seen high rates of price increases in the 70s, and certainly if you compare our CPI today to what it was 20 years ago, it was a pretty big increase. It's more than much more than 30% is my guess.
Not in 1 year.
Not in 1 year, and this wouldn't happen probably in 1 year. Probably happen, probably occur over a couple-year period, and but there's also some good, in some sense, macro effects out of this. And this is the last point, which is and this also comes back to the issue of the tax rate, which is that you gain about a $1.5 trillion capital gain on existing federal debt by inflating by 30%, because the federal debt in the hands of the public is about $5 trillion. 30% hike is about $1.5 trillion. That's not incorporated in any of these tax rate calculations. That's an extra freebie to kind of counter the concerns about evasion. $1.5 trillion can take you a long way for a lot of years to deal with evasion.
Why don't we take 3 questions, and then we'll take a short break. There's a lot more than that. Okay. You were first. I
wanted to ask my one
for a second.
Okay. Was one obvious form of old capital that gets very hard by the fair tax is ESP planner, along with all the human capital. And it might be almost 100% on the ESP planner, right? Because we wouldn't need it all, right? Basically, economic historians might need it. So then I was just
we can solve that thing for something.
I was just thinking about this. The 13 years I can understand, it's intellectual curiosity, but then we have the commercialization, which costs money and time.
Yeah.
So there's 2 possibilities. Either you're a really big short-run profit, or you believe that the chance of the fair tax or something like that passing is low. So my last question was, what is your honest belief about the probability of getting something clean enough to derail ESP planner? Something close to the fair tax, clean enough to derail ESP planner. Simple enough, that is. What's your real view? What's your real probability?
Of the prospects of getting the fair tax adopted?
Or something like it, or something close to it.
Geez, it's 0.8. I'm an optimist. I think it's
How much are you willing to put on the line? That's all right.
I think it's an 80% chance. I've given a lot of. I've done some work for Leo and his group on a consulting basis and a fair amount for free. So I've kind of invested myself to some extent in the possibility that it would happen. I think a lot of it depends on getting somebody like Giuliani to speak publicly about this and in a way that can respond to some of the concerns about how high the rate would be, how much evasion, and also to get across the point that this is a budget. This is not a budget balance amendment, but this is a way to achieve fiscal responsibility through time. That this is a fiscally responsible way to move ahead.
All right. Well, we can go on to the next question. Just noted that one.
Okay, first thing is I don't really see the political economy link between doing this and getting rid of the fiscal gap. And once you have the fiscal gap in there and the likelihood of rates have a likelihood of rates going up in the future, then of course you do have a tax burden on saving because you're expecting to have a higher rate when you consume in the future. So I just wanted to throw that in as a factor. The second thing, I just can't resist saying this, which is that I got a call from a reporter recently saying, I've been told that under the fair tax, prices will stay the same, pre-tax wages will stay the same, after-tax wages will go up by the fact that you're not being withheld, the government will still have the same revenue. Isn't there something wrong with this picture?
Yeah, well, there's lots of people who are talking about the fair tax who aren't economists, lots of radio speakers on the issue. I mean, yeah, you're absolutely right. If the tax rate goes up through time, that's like an effective capital income tax. But that's why I've been talking about more than just the fair tax. I've been talking about reforming dramatically the Social Security system and also the healthcare system fundamentally, and also getting us out of Iraq and cutting discretionary spending. Because I think all these things together can get the fiscal gap down to zero. That's the New Deal on the website.
I have comments about compliance, that is not going to be a difficult issue, because we're reducing the amount of filers from 140 million to 14 million, which will be very easy to monitor with what we have. And by the way, 90% of those payers will be huge corporations, the Walmarts, the huge stores. So they're going to be the ones that are going to be the tax collectors in this event, and they're going to be the ones that do not want to have physical exposure in the media. And then the last group are the little lawn boys out there that are mowing that we think are going to evade taxes. I disagree with that, because from my readings, that person who has that little business wants to buy those lawn mowers at a cheaper rate. When he does, he has to be registered as a business in order to get a cheaper lawnmower to do his service. So once he has registered as a business, he will also be audited by the state auditors because he exists as a business.
Interesting. Good question. Oh, a good point.
Just a quick comment on some of the tax rates that are reported in the paper. Larry certainly knows from other things he's done about the heterogeneity of tax rates on savings, and everything that's presented here takes the view that the households in question are saving in the traditional outside the IRA 401k universe. I think it might be useful to present, since for many of these modest income households, most of their saving is now being done through the tax deferred pension channel, to basically show that they would in fact face zero tax rates on savings today. They may face positive, they may face negative tax rates depending on the future trajectory of the tax code. But we know that the tax rates that are reported here may not be the ones that are completely descriptive of what they face.
Yeah, that's and Dave and I are writing this paper for the journal you're editing, Jim, and we'll try and include those that paper is going to include the state taxes as well, and also the sales taxes.
Last question.
Larry, I think I agree with the point that transition rules are probably less likely under a retail sales tax than under a VAT, but I do wonder a little bit more about the choice between the two, because we've had worldwide a tremendous amount of experience with the VAT, and the VAT has some significant administrative advantages. You collect the tax early. If you miss the tax early, you get it late, as long as you don't miss it at the retail stage. There's an audit trail if you use the credit invoice approach. If you want to include it in the price of the good, you could under a VAT very easily. And it's a natural way to tax businesses. Under the retail sales tax, that component really isn't there, and the only experience we have at any meaningful level is the experience with the states, and the estimates there are that the consumption tax base of the retail sales taxes in the states is about 40%, business purchases, which gets us back really in the income tax realm. And if we have a tax which would be administered anything like that, we really couldn't claim the advantages of consumption taxation for such a tax. So I guess I'd like to hear maybe a little bit more about your views about the choice between the two.
Well, again, if you could do the VAT with, if it's, I'm not an expert in tax collection, but it seems like most people who are think that the VAT's more collectible. If you could do a VAT and not have evasion, and not have transition relief, and you could also hope to make it very clear to the public that there's just one 23% rate VAT, and people could really understand it just as well as that it could be just as transparent, then why not? If the public would go for it. But Leo has invested a lot of his group's resources into actually polling people, having focus groups to understand what people really want and what they would support in terms of yelling at their congressman to vote for it. And it comes down to the sales tax that they're really supporting. They're not supporting the VAT. I think it's hard for them to understand the VAT. And so they're very keen on the sales tax. So again, it might be that this is that the VAT would in some ways be better if you could again keep it from being eroded with respect to the transition rules. But maybe that's not going to ever happen. But politically, I think the fair tax has a shot because I know there's very strong support in not necessarily in Washington at this point, but among the millions of people that are actually in Leo's organization.
Thank you.
Yeah.